Hello everyone. It is Monday, November 23rd, 2020. I'm John Kosar from Asbury Research and Asbury Investment Management, and these are your Daily 5. These are my most influential charts and data series for this week. Let's take a look at them. Number 1. The benchmark S&P 500, no follow through on the November 9th breakout. And here's the chart. We see the S&P 500 here daily, going back to May, along with its 200-day moving average, which is a major trend proxy. After a little bit of deliberation here in June, we made a nice 45-degree move up to the September 2nd high, and that's where the indecision started. We quickly had an 11% move down to the September 24th low, which was kind of a loose test of the 200-day. Rallied back up, but we couldn't make a new high. We stopped on the October 12th peak, which was an 11% move off of that September 24th bottom. And then we collapsed again just above the 200-day moving average, this time to the October 30th low. And then we had a little bigger move up where we exceeded the September 2nd high of 35.88 on November the 9th. That was when Pfizer came out. It was the big news about the vaccine that came out. The S&P opened 150 higher, and then it slowly slid back underneath 35.88 by the close that day. And we've been trying to get something going ever since. So we're really still an investor indecision. However, the breakout that took place on November the 9th is still good. That's still a valid breakout. We actually had a couple of closes, tepid ones, but a couple of closes above 35.88 last week. As long as we stay up above 35.05, which is the top of this coiling pattern that we've been in for 2 months previously, this pattern is still valid, and it targets a move to 38.50, which is an 8% rise to where we are right now. But we really need to get off the dime. I would like to see this market get back above 35.88 and hold that breakout. I think the longer it sits sideways, the more vulnerable it is to move back into this investor indecision. Number 2, market internals, the Asbury 6. I pay a lot of attention to market internals, more than I ever have during my career, and it's because the computers and the algos seem to rule the roost on a day-to-day basis. Most of the volume day-to-day is from these algos, and as a result, you get a lot of choppy movement in the indexes, a lot of fake breakouts in the indexes. So this Asbury 6 are 6 different tactical indicators, and only one of them, which is the rate of change in the S&P 500, has to do with price. These other 5, relative performance between stocks and bonds, investor asset flows in the spider, corporate bond spreads, trading volume, and market breadth, they're all secondary indicators which I use as kind of a lie detector test. So our Asbury 6 shifted back to positive on November the 4th. What does that mean? That means that all of these indicators, these are all positive because they're in the green category, and these are all dates in each of these cells to indicate when each of these individual constituents of the Asbury 6 turn back to positive. As long as they stay in positive territory, our bias is towards higher prices, and that the S&P 500 is going to be able to hold that underlying support level and eventually move to fresh highs. Tech is lagging though. This is an important chart for us this week. The composite index, the Nasdaq Composite index, indicates apprehension by investors. And here's that chart. This also goes back to May. Here's the comp here, daily, and its 200-day moving average. You can see the patterns are very similar. The difference is the attempted breakout here in comp has even been more tepid than the one in the S&P 500. This is atypical. Usually when you're in sideways congestion for a while and the market breaks out higher, tech's usually leading. This time it's lagging. You can still see we had this pop up above the investor indecision area here on November the 9th, but we really never got a clean breakout over the top of this pattern since then. 11,940 is the level that it needs to get above. If it gets there, it targets an additional 11% move higher to 13,300. But again, this is a little bit distressing to me because tech should be leading and it's not. A chart that I don't have here that is worth mentioning is I follow very closely the total net assets invested in the Qs, the QQQ, which is the ETF that tracks the NDX, the Nasdaq 100. And that has been, those assets have been flat for 2 months. There's not a lot of new enthusiasm, not a lot of new conviction going into the tech space. Until that changes, the S&P 500 is going to have a hard time moving to new highs without the assistance of tech. Number 4, market volatility supports higher equity prices. This is one piece of good news that we're following. Here we have the S&P 500 up on top daily going back to June, and down at the bottom is the VIX with its 21-day moving average. Why the 21-day? Because that is one business month, and that's our tactical time period. So you can see the VIX has been underneath the 21-day moving average since November the 4th. That's coincidentally when our Asbury 6 turned to positive. You could see between August 27th and November 3rd, when it was up above the 21-day moving average, this was that sideways investor indecision period where the market couldn't seem to get off the dime. Prior to that, it was underneath the 21-day moving average here from July 1st to August 26th, and that helped to facilitate this nice move higher that we had during that period. So right now, the 21-day is at 28.68. As long as, or I should say, the longer period of time that the VIX is able to remain underneath the 21-day moving average, the more likely it is that the S&P 500 will eventually get its bearings and start to make new highs. Finally, strategic momentum. Beware of mean reversion. What do we mean by that? The market, equity prices tend to revert to the mean. So we're very interested in how far they're getting away from the mean. And right now they're pretty far away. Here we have the S&P 500 here daily. This is going back all the way back to 2001, along with its 200-day moving average. Now this blue line in the bottom is the percentage that the S&P 500 is actually above or underneath its 200-day moving average. And there are some clear-cut parameters here. You can see when it gets to around 27% underneath its 200-day moving average, that's when bottoms form. We had one July 2002, Nov 2008, and March 20th of this year. On the flip side, once we get to above 14%, that's where you tend to get moves to the downside, stalling on the upside. You could see that most recently in January 2018, we had a peak where we got pretty close to that 14% area. Back on February 21st, we were at about 13%, and that was right in front of the nasty decline we had this year between Feb and March. And now we're up at 15.4%. This is not a sell signal, but what this does for me is it tells me to pay closer attention to the next tactical signal, and that's going to come from our Asbury 6. So because we are so far away from the mean, because we're 15% above the 200-day moving average, the next time that the Asbury 6 starts to turn red and tell us that internally the market is breaking down, we're going to be looking for a potentially larger move lower, corrective move lower than the typical 5 to 6% move that you'd see in a healthy bull market. So there you have it. That's your Daily 5 for this week. Thanks for watching, and you have a wonderful and safe Thanksgiving holiday. See you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.